Everything in your trading journey does not matter at all unless you know how to read technical analysis correctly. If you don't, you simply will not make any money in your trading career at all. Now, I know you've heard different forms. You can do market sentiment, you can do news, trading fundamentals, you can do bar candles, all this different type of stuff. But honestly, all that stuff is way too unpredictable. Technical analysis is actually the most predictable type of trading simply because you are repeating what price has done to the left. Literally, all you have to do is look to the left to know what the right is going to do. Patterns repeat themselves every single day in the market, and they will forever as long as the candlestick charts continue to print out candlestick charts. Now, if you don't know technical analysis, or you might want a little bit of clarity on market structure, certain things about it, that's exactly what this video is about. So make sure you watch the video all the way to the end because I'm going to give you a full-on video on how to properly read technical analysis and how I've been doing it for the last about 6.5 to 7 years. So first things first on technical analysis is going to be the actual candlestick chart. So this is where you're actually going to be trading. So there's many different types of charts out there. There's the line chart, there's bar charts, and then there's candlestick charts. Now there's plenty of more charts, but I simply have no idea what they are. And honestly, you do not need it to be successful. All you need is to know candlestick technical analysis chart, which is what I'm going to explain to you right now in this part right here. So coming over here to trading view, this is what every single person first sees when they come into the market. They see all of these red lines going down, red lines going up, or boxes going down and boxes going up. And at first initial sight, this might be very, very confusing, and it might be almost overwhelming because you don't know where you should be looking at. Should you be looking at this point right here to get started off in? Should you be looking at this point right here in order to get started off? There's so many different areas for you to actually be looking at in this chart that you don't know where should you be looking at in order to make money in the markets, right? Because the point of you coming into this and watching this video and learning technical analysis is because you want to make money in the markets. Well, this is what you need to mainly focus on, and that is these technical analysis patterns on the candlestick chart. So this chart right here is a candlestick chart. As you can see right here, these are different types of technical charts that you can analyze. You can have the bar chart, you can have the line chart, you can also have the candlestick chart, which is the most famous one. And then obviously you have all of these different types of charts, which I honestly have no idea how to read, and I've never even attempted to. At the end of the day, all they do is simply represent price on real time in front of your face in a different type of way. So they just represent the market going up, or they represent the market going down, all different types of format, but they're all doing the same exact thing at the end of the day. That is representing price. So you want to make sure that you read this technical analysis chart for what it is. And the easiest way to do that is on the line chart. So we're going to be going into the candlestick chart a little bit later into the video, but so you guys get the first initial thought, we're going to start off in the line chart. So here in the line chart, it's very straightforward. You have steps going up, which is technical analysis bullish market, and then you have steps going down, which is technical analysis bearish market. Bullish market are buys, bearish market are sells. And in this perfect example right here, you can see how the market is having a bearish market to the downside. And then you can see how in this example right here, you can have bullish markets to the upside. So both of these are technical analysis charts. So you're analyzing the chart to determine whether the market is going to be going up or whether the market is going to be going down. Very simple, very self-explanatory. But when you get into the market and you see this ending point right here, this is where the price is actually live right now. So this is currently Euro USD, which is the most traded currency in the whole entire foreign exchange market because it's the main currencies that are traded, which is the US dollar and the euro dollar. So obviously that makes this pair the most traded pair in all of the foreign exchange market. So this is where price is currently right now. Price is currently trading at 1.08459, which is the last point where it left off on market close on Friday. So what you want to determine based off of this price is, what can it do now? Can it go to the upside or can it go to the downside? And this is where you would have to look at the technical analysis to determine if it's gonna go up or it's gonna go down. What's gonna make the most sense? Because at the end of the day, it's gonna do either or, go up or down. You just have to find an edge on where it makes most sense to go up rather than down, or go down rather than up. So you do this by reading the technical analysis. So the first things that you would want to focus on is on the most recent price, which is going to be this area right here. When you're analyzing technical analysis, a lot of traders get confused and they want to start really far back over here, or they want to start off in the middle. And you can do that just to kind of get into the flow of the market. But you want to make sure you just focus on the last leg of that, because this is what's going to determine what the trade is going to do. Not what happened 4 months ago or almost a year ago. Like, that stuff is cool to know what it did back then, but if it's not relatively close to where price is right now, then it simply doesn't matter. It's just taken away from your time and taking you away from the focus of what actually matters into the chart. So this right here is just the line chart. So this is just so you guys can see the steps going up and the steps going down. But the proper way on how to actually look at this is on the candlestick chart, which is going to be this section right here, which is called candlesticks. So if you notice, if I go back and forth really fast from the line chart to the candlestick, it is the exact same thing, just being represented a different way. And you now know to not be confused anymore, because you now know these steps going down, instead of it being drawn in a line, it's now being drawn in candlesticks. Because at the end of the day, you trade candlesticks, you can't trade the line chart. It's just not accurate. So this candlestick chart is what you are going to be looking at when analyzing your technical analysis when you're already on step 2. Step 1 is get the feel of the actual line chart. Learn what the line chart is going to be doing, get the flow of it, understand it, and then you move on to the candlestick chart. And the simplest analogy that I can put for this is almost as if you're learning to ride a bike. When you're first riding a bike, you have the training wheels. You just do that so you make sure that you don't fall to the side and you get the hang of it. After you're done learning how to ride the bike, you simply take off the training wheels and you continue to ride the bike exactly how you're riding it. The only thing that changes is you don't have the training wheels. So you still obviously have a risk of falling, but now you're experienced and that obviously won't happen. So you're still riding the bike the same exact way, nothing changes. The only thing is you have the safety wheels off. Same thing here. You're analyzing the market exactly the same as you would here, but now you're removing the safety of having the line chart and now you're focusing on the candlestick chart, which is the real way on how you're going to be trading. And you take off the safety wheels on the bike because that is the real way on how you're going to ride a bike. So this candlestick chart is formed by different types of candlesticks. So every single candlestick as of right now represents one single day, because I am currently on the 1 day time frame. So every single candlestick is 24 hours. So this right here is a 24-hour candlestick. This right here is a 24-hour candlestick. Every single candlestick is a 24-hour period, and that is what this chart is made up. If I simply change this time frame from the daily to then the 4 hour, now every single one of these candlesticks is going to consist of 4 hours. That little candlestick is 4 hours, and every single one of these candlesticks is 4 hours, including this big one right here, because this is currently the 4 hour time frame. And obviously I could go all the way down to the 30-minute, and every single one of these candlesticks is a 30-minute time frame. And this is the simplicity of how you analyze with the candlesticks. Now, all we're doing when we're changing time frames is we're essentially just zooming in to price. So as you can see on the 4 hour, if I were to circle this one single candlestick, this just looks like I'm just circling one single candlestick, which happens every 4 hours because I'm on the 4 hour time frame. But if we were to go down to, let's say, the 30-minute time frame, as you can tell, I'm actually catching a lot more than just one single candlestick. Why is that? Well, that is because all of these little 30-minute candlesticks, because now we are on the 30-minute time frame, creates this one 4 hour candlestick. So every single one of these 30-minute candlesticks are their own situation, and all of them together create one 4 hour candlestick. For example, in the 2 hour time frame, if you notice these two candlesticks right here, which is going to be these last two ones right here, creates the accumulative of one candlestick because it is the 4 hour candlestick. And obviously this obviously goes on to the daily and the weekly and so on and so forth. If I were to put one big circle around this big candlestick and then I go down to the 4 hour, every single one of these candlesticks creates that daily candlestick. So a lot of people don't understand how to flicker back and forth from the time frames and how to actually determine what these candlestick and technical analysis is doing, all we're doing is looking at the same exact market in just different types of ways. We're looking at it in bigger variables or in smaller variables, but we're looking at the exact same thing. Absolutely nothing changes. For example, you right now watching this video, you can be watching this video on your phone, on your computer, on your tablet, on your TV, or honestly on an Android, doesn't matter. You're all looking at the same video, just in different types of ways. Some of you guys are looking at it on a bigger screen, some of you guys are looking at it on a smaller screen. But at the end of the day, it's doing the exact same thing, and that is representing this video, showing you guys the #1 technical analysis video, which I'm going to get later into it. And if you're watching this on a laptop or on a phone or something, hit the subscribe button. It's right here, or right here, doesn't matter. But the point is that when you're looking at the market like this, you are literally looking at the same thing in different formats as if you were to be seeing this video in the same way, but in different formats. So now that we understand what the candlesticks are and how that consists of technical analysis, because all of these candlesticks together create the technical analysis. Without these candlesticks together, we will not have technical analysis, and we won't have these patterns that happen every single time again. And that takes me to the next point, which is going to be trending markets. So these candlestick patterns, they create a pattern with it. And these patterns create trends to the upside or trends to the downside. And the key to trading is trading with the trend. The trend is your friend. I know it might be cringe. I know you might have heard it a million times, but it's what I do every single day. And if I were to not do this every single day, I would not be in the successful position that I am today, because going against the trend is not only hard, but it's not gonna make you money, and it does not make any sense. So this is what a trending market is going to look like because of the candlestick patterns that we have identified with technical analysis. So everything right here is extremely simple and easy to understand. This right here is clearly a trending market to the upside. What you want to make sure that you focus on is at the last point of price, right? When you see this right here, do not focus on this point right here. Do not focus on this point right here. Do not focus on anything that is not the last point. Because once you understand the last point, then you start working backwards. Once you understand where the market is right now, now you start looking backwards. You're like, okay, if this is the high of the market, okay, what is this point right here? Well, this looks like a low, and then this looks like it left a trail of the market heading to the upside. It is so easy to spot that this market is heading to the upside because you identify where the market is actively right now. And once you understand where it is actively right now, you just follow its trail, and it's gonna literally tell you what it's doing. Clearly, this market is bullish. Same thing as if we were to be identifying this market to the downside. This market is heading to the downside. It would look something like this. You should only focus at the lowest points or wherever the market is actively live and the last point in the market, and you simply just follow the trail. If this is where the market started, you simply follow the trail to whatever it does, and you can clearly see that it's left you a pattern of the market heading to the downside. This is how you determine the trend of the market. You need to spot where the market is actively right now. Where's the last point that the market is at? And then you just work backwards. Because vice versa, if you were to come into the market and just simply look at it right here, you wouldn't know if to focus on this point right here. You wouldn't know if to focus on this point right here. All of this is absolutely irrelevant to what is happening on the live price all the way over here. So if we were to come over here and identify this point right here, you would identify as your last structure point here. Then you would start working backwards. If you start working backwards, then you can identify what this market is clearly doing. It's very simple. It's very straight to the point. Without this, it is going to be very hard to identify what the trend is doing. Because in the other way, if you were to try and find something by looking at all of this information overload, you're gonna almost get confused and overwhelmed, and it just honestly kills your trading motivation, and it just deprives you from what you should be focusing on. And that is, where is the market right now? Do not focus on where the market was 3 years ago. Perfect example is this market right here. If you were to be looking at this market around here, it'd be a little bit confusing. You wouldn't know if it's upside, if it's downside. But if you were to look at the last point of where the market is, which is clearly this highest point right here, you simply draw your little circle here, and then you just start working backwards. You start working from the top to the downside. And you can see that this market has been creating higher lows and higher highs to end up creating this market to the upside. So this is where the trend is your friend, because after you identify that this market is to the upside, well, then now you would clearly only be looking for buys. Why would you be looking for sells? And if you sometimes don't have too clear if it's a buy or it's a sell, or you're even a little bit better at analyzing sells and buys or buys and sells, all you have to do is simply come here to this section, right click it, and then you would invert your scale, and then you completely look at the markets in the other way. And this is literally showing you the same exact market, just flipped around. It's almost like if you're watching this video and you laying down on your bed and you have the screen sideways, you just flip the screen to the side. You're looking at the same thing, you just flipped it. Same thing here, the same market, but if you have some type of difficulty identifying whether the market is to the upside or the downside, or you're only good at looking at buys, or you're only good looking at sells, all you have to do is just flip the chart. So here it's obviously very clear that this market is to the downside, because again, remember that we flipped it. We would identify this as our low point, and after we identify it as our low point, we can simply follow the market and see that it was creating lower lows and lower highs. Now, this trend is consisted of lower lows and lower highs if you're bearish, and it's consisted of higher highs and higher lows if you're bullish. It is absolutely impossible to have a bullish market without a higher low and a higher high. And it is absolutely impossible to have a bearish market without lower lows and lower highs. Let me explain. So this right here is a perfect example of a bullish market. A bullish market is consisted of higher highs and higher lows. It is impossible to have a bullish market without higher highs and higher lows. And it is impossible to have a higher high without a higher low. It is impossible. You could only have a higher high if you have a higher low. So make sure you pause the video and write this down. So this right here is bullish because we are above the higher low and within the higher high. If this market were to do something like this and have a retracement and head to the upside, well, now this is the new higher high within this market. So the higher high gets moved, and then the highest low point gets moved to the next highest low point, which is this point right here. Now, this is a perfect example of a bullish market. The moment this market decides to have some type of retracement into here, this point is now considered a new higher low and a higher high, only because we've broken above the previous structure point. If we did not break above the previous structure point, we simply do not enter this as a bullish market. So this right here is a higher high, and then the higher low would move up to the next higher low. Now, this example right here is not a higher low. Why would you count this as a higher low? Because it's having a pullback? Well, no, not necessarily. This could only be counted as a higher low once this market has created a higher high. Again, remember, it is impossible to have a higher high without a higher low. So if this market right here did not create a higher high, how would you mark this as the higher low? You're pretty much skipping a step, because this market right now can clearly do something like this, and it can completely go to the downside because it hasn't shown you its full potential yet. This market will remain bullish as long as we are above the higher low and within the higher high. Meaning, this market can literally do whatever it wants. It can literally do all of this right here, anything it wants. The moment it breaks above, we now have created a new higher high. And the moment it breaks under, we have now had a break of structure, and now this market is bearish. So this market can do whatever it wants in between the higher high and the higher low, and we are still bullish. The moment we break above, this now turns into the higher high, and then this now turns into the higher low, which is going to be this point right here. Now, the moment we break under this point, now this market has completely shifted to the downside because we have broken under the higher low. So the moment we body close under this higher low, now we are bearish. When we are bearish, it is mandatory to have a lower low and a lower high. You cannot have a bearish market without a lower low and a lower high. So what does that make this point right here? Well, that makes this new low point a lower low, and that makes the last structure point a lower high. Now this market is bearish. Now it might look bullish overall because a beginner trader would come into the market and then it would see something like this and they'd be like, yeah, this market is heading up. And that is where they are completely wrong. They're not paying attention to the market structure where it is clearly showing you that this market is now bearish. So now this market would then have some type of retracements and then do something like this. Now this is a new lower low. And again, it is impossible to have a lower low without a lower high. So that is where this lower high would then move to this point right here. So again, same thing applies as if the market were to be heading to the upside. This market could do whatever it wants here, go to the upside, to the downside, and it mean nothing. The moment we body close above this market, we are now bullish. And the moment we body close under this market, we will continue to become bearish. So if this market closes under this point, this is now the new lower low, and then this is now the new lower high. So this market can simply do something like this and go like this. Now this market is no longer bearish because we have broken above the lower high, making this the new higher high, and then making this point right here the new higher low. It is impossible to have a bullish market without a higher low. It is impossible to have a bearish market without a lower high. Write this down. The moment we body candlestick close under a higher low, we are now bearish. And the moment we body candlestick close above a lower high, we are then bullish. This is major key to understanding what the trend of the market is doing, so you have extreme clarity if the market is bullish or bearish. This way you can determine if you're interested in buying or if you're interested in selling. So this trend is identified obviously very simply on the line chart. So I can come into here to this market and I can simply throw on the line chart and you can simply identify, well, this is clearly the higher high. And after you identify the higher high, then this would be the higher low. Very simple, very straightforward. It's literally the same thing that we were just doing, but on the actual live markets, but on the line chart. So this would be the higher high, and then this would be the higher low. What we would do is we would anticipate for this to have a pullback in order for this to head to the upside. If this market decides to now break this higher low, now this market will be bearish, and then this will be the lower low, and then this would then be the lower high. This is very simple and happens every single day in the markets across every single time frame. So the way you identify the trend is exactly the same as you were to do it on the weekly or the yearly or the 10-year or the 100-year, as you would on the 1 hour, the 10-minute, the 30-minute, the 1 minute. It's all the same thing because at the end of the day, it's all showing the same exact lines, the same exact line chart, same exact structure. It's all the same exact thing. If you notice that this right now, we're on the weekly time frame, meaning each and every single one of these candlesticks is 1 week. And when we were to look at this now on, let's say, the 15-minute, you can see how we have an exact same amount of lines. Now these lines were obviously looking a little bit more rigid because the 15-minute moves a lot faster than, let's say, the weekly. But if I were to hide what time frame we were on, you would realistically not be able to tell if I were to zoom in to something like this, because it is simply lines. It doesn't matter if it's the daily, it doesn't matter if it's the weekly, they all look exactly the same, representing market structure to the upside or market structure to the downside. So this right here is the real markets, right? So this is this exact market right here, but now on the line chart. And you're going to notice that every single little sharp edge, it's going to be a market structure point. It's going to be a potential higher low. It's going to be a potential higher high. So this right here is a prime example of simple and straight effective market structure. Market structure is literally every single point that you are seeing right here. This is market structure, which is, I like to call them an elbow because it literally looks like an elbow, like it looks like a sharp edge. So this right here would be an elbow, which is market structure, an elbow, which is market structure, and an elbow, which is market structure. And clearly we have these elbows everywhere throughout the market. So if we go here to the real market, you can see how we have these elbows or these market structure points everywhere throughout the market. You can see how this right here is your elbow right here at this point. You can see how we have another elbow at this point. We have literally elbows all throughout the market structure that this market is creating. This is a little elbow, obviously a sharper elbow, and then this is more of a wider elbow. So you get all different types of elbow. If you're a fat guy, if you're a skinny guy, you got everything that you need here. So these elbows are market structure, and this market structure is what creates the trend of the market. It's what creates the market if it's heading to the upside. It's what creates the market if it's heading to the downside. So when you have a bullish market like this is obviously higher high, and then this would be the higher low. But if you notice, that higher low is a market structure point. It's this, the higher low, and then this would be considered the market structure point. And previous market structure is this elbow right here and this elbow right here. So everything that looks like an elbow, like a triangle, like a corner, like a sharp edge, is market structure, and that helps determine the trend of the market, whether it's going to the upside or whether it's going to the downside. You can literally flip this chart right now and you can see how it's the same exact elbows but going to the downside. So everything that we do in trading, whatever you apply to buys is the exact same thing that applies to sells. Nothing changes. Your edge is not better on only buys, or your edge is not only better on sells. It is the exact same pattern, the exact same market structure, the exact same everything. The only thing is that it flips from one side to the other. So now that you understand what the technical analysis is, now you understand what trend is, which is extremely important. You understand market structure, which market structure is all of these elbows, and it's honestly what the market is created of, because without these elbows, market would not exist. You would simply have a chart that would look something like this. It would look like a literal wave, and obviously you cannot trade a wave because it's just not accurate. You would need these sharp edges to determine when the market is going to go up or when the market is going to go down. It's a lot more predictable. Thank you for the market structure, trading legends, or whoever created this shit. And that takes me to the next point, which is going to be support and resistance. So support and resistance is identified because of these elbows. Without these elbows, you would not be able to determine what is a level of support and what is a level of resistance. So again, remember, what is support? Well, support is something that holds something up. For example, this table. I can use this table as support to push myself to the upside. I'm going to use this as support and as leverage to push myself up. What is resistance? Resistance is something that is holding you as a ceiling, that is pushing you down. Let's say I want to use the bottom of this table as resistance to pull myself down. This is being used as resistance to pull myself down. If you notice, the same table is being used for support and it is being used for resistance. It is the same exact spot being used for two things, because that is exactly what happens in the market. You can have the same level of support be used as resistance in the future, or it have been used as resistance in the past. The support and resistance is consisted by these market structure points that has happened in the market previously in the past. So let me show you. So this right here is a level of support and resistance. Oh, by the way, it's the same shit as supply and demand. It's the same shit as order blocks. It's the same shit as all these different types of terminology. It's all the same shit. Support and resistance is the same thing as everything. Literally the same thing. So right here, you can see how this level of market structure, which is this elbow right here, is considered a level of resistance that then in the future was used as support. So this level of resistance, which is a market structure point, was then used as support, which now created a new market structure point. Then you have this elbow right here, and this elbow, as you can see, creates a level of resistance. This level of resistance is then used in the future as a level of support. I'm gonna bring it down for example's purposes. And then this is now a new level of support that created a new higher high. Now this is a new market structure point, which is used as resistance. So we can determine that this can potentially in the near future have a pullback and use this area as a support point to then push the market to the upside, where then this would be creating a support level, which is a level of market structure. So notice how market structure is created based off of support and resistance, and support and resistance is created off of market structure. They both work together hand in hand in order to create a trending market or to create a bearish market. Now, these levels of support and resistance happen everywhere throughout the charts. So if we were to come here into the live markets, which is what's going on here, you can see how this live market, you can see how a level of resistance, which is this point right here, is then used as support. So this point of resistance is then used as support. You can then see how this level of support is then used as resistance at this point right here. And then you can see how very easily this level of resistance right here is then retested and use it as support. So this literally happens time and time again into the market, and it's a pattern that repeats itself over and over again. I could drag this same exact spot a little bit more to the right, and you can see how this level was used as resistance. Drag a little bit more to the right, you can see how it was almost used as resistance right here. And this is what market structure is consisted of in order to create this level of support and resistance. Now, keep in mind that the level of support and resistance is to be respected about 60 to 75% of the time. Price doesn't always have to react off of a support level, or it doesn't always have to react off of a resistance level. It is statistically proven that it should, but you cannot rely your whole entire strategy just on that alone. You need to have an edge over the market as a whole, but you should only be buying at a support level or only be selling at a resistance level. You can have the best edge in the market and you can have everything you need to have in order to take a trade. But if you do not have the area of support to buy, how are you buying? Like, how are you gonna push yourself off the table if you're not off the table? You can't, like, I don't know how to kill gravity, or I can't like levitate myself using mental force to just push myself off the table without physically touching the table. It's the exact same thing with the markets. You want to only be executing a trade if you're at that support level, if you're at the table. If you're not at the table, simply cannot do anything with it. And obviously the same thing happens with resistance. I can't pull myself off of this table if I'm not physically at the table. So when you're looking for areas of support and resistance, do not pay attention to the charts. Do not execute a trade unless you're actually at the level of support and resistance. So after you understand how to identify these levels of market structure and you learn how to identify this level of support and resistance, you actually have to execute this trade on something. And the only way for you to execute it is on the actual candlestick patterns. Because the line chart, again, it's just for a very beginner section. It's just for you to understand how to read the market, but you can't trade off of the line chart. So this is where you would have to go find your candlestick pattern in order to execute the trade. So this is where you would then obviously flip over to the candlestick pattern. And I'm going to teach you the most powerful and most effective candlestick pattern that I use every single day. But after you hit the subscribe button, you got to do it. I know you haven't done it. I can tell. That's why you're doing it here again. Just hit the subscribe button and then we can carry on. I'll give you a second. Go ahead. All right, perfect. So now that you subscribe, this is what the perfect candlestick pattern is. It's what I use every single day. If I don't have this, I do not enter the trade. And that is going to be, drumroll, a bullish engulfing candlestick for buys or a bearish engulfing candlestick for sells. I know you might have heard me say it in the past, but it is as repetitive and as redundant as it is. It simply works, and I do not have to change anything of my trading strategy. And when it comes to technical analysis, there's nothing you need to change in order to properly identify the market correctly. The only way you can confirm that something is going in one direction versus the other is if you have momentum. How do you identify the momentum? Well, if price is engulfing the previous price. If price is engulfing the previous price, it is clearly showing action of strength and is clearly showing that it is dominating that market. So that is your entry confirmation that you're looking for in order to enter the trade. For example, if you were to identify in a race who is winning, well, you're going to identify that the person that is engulfing the other car and beating them by a lot is winning. You're going to bet on that guy. Well, same thing in the market. You want to bet on the candlestick that is winning, the candlestick that is engulfing, that's eating the last couple of candlesticks. And the only way that you can bet is when you know that that is happening. Imagine you can bet on a race when you already see who's winning. The odds of you making a lot of more money are literally right in front of your face because the winner is already ahead. So you just bet on the winner. It's the same exact thing here in the market. Once the market creates that bullish engulfing candlestick, it's the winner already getting ahead. That is your confirmation that you can then get into the market. It's showing you who is winning, so you go with the winner. Now, if you bet before that, you're taking a bit of a risk because obviously you don't know if there's a pretty much lock that the trade is actually going to go into that direction. It could be a better entry and you can have better odds, but the probabilities are not so much in your favor as if you were to already see who is winning the race. And this candlestick pattern is actually one of not only the most powerful, but the most simplest because there is hundreds of different types of candlesticks. And these are all different types of indications when to enter the trade, when to avoid a trade, but this is specifically when to enter a trade. So let me actually show you what this looks like. So this right here would be a perfect example of a bullish engulfing candlestick pattern, which is this right here. So you can see how this blue candlestick has engulfed the last 1-2 candlesticks, confirming that this direction is now going to head to the upside. You can also see how this humongous red candlestick is engulfing the last 1, 2, 3, 4, 5, almost 6 candlesticks, confirming that the market is now going to head to the downside. You can see how this candlestick right here has engulfed the last 1, 2, almost 3 candlesticks. And again, keep in mind, currently we are on the daily time frame, meaning that this one single day has eaten the last 3 days. That should give you indication that there is a lot of sellers into the market that you should be interested in trading. Picture as if there's a race and there is a 3-day ahead race. I imagine that the cars are racing for weeks at a time. And there's this one car that has now skipped everybody by 3 days. It has 3 days ahead of all the 3 other cars. Doesn't it make more sense to bet on that guy that is ahead versus the guys that are behind? Well, that is the possibility that the market is giving you by entering a trade after it already shows you its hand with this engulfing confirmation. Now, you have to be very patient in order to wait for this to happen. And this is where a lot of traders mess up because they don't want to be patient. But at the end of the day, patience pays. And if you don't have the patience, you simply are not meant for this. Sorry, it sucks. But if you don't follow the rules of trading, you will not succeed. It is as simple as that. Because why should you succeed if you're not being patient? Rather, I have to be patient to then get the same success. It's simply not fair, and it's just not how the markets work. You have to follow the rules in order to get the reward. You can also see a perfect example of this engulfing candlestick right here. So you can see how this engulfing candlestick engulfed the last 1, 2, 3, 4 candlesticks. This right here is not an engulfing candlestick. As you can see, this little candlestick did not eat the last red candlestick, so it does not make it an engulfing candlestick. You can tell how this red candlestick is not an engulfing candlestick. This is an engulfing candlestick because it ate the last several candlesticks. This right here is not an engulfing candlestick, this little blue one, because it did not eat the last 1 or 2 candlesticks. So an engulfing candlestick is when it eats a minimum of 1 candlestick to the left of it, whether it is to the upside or it is to the downside. Without this, it is not an engulfing candlestick. This right here is a perfect example of a beautiful, strong, bullish engulfing candlestick, which it has eaten the last 1, 2, 3, 4, 5, 6, 7 candlesticks in one single day. So this candlestick is 7 days ahead of everybody else. Obviously, you can then see how the market followed to the upside, and that confirmed that that was going to be the winning trade, the winning car in the race. And this candlestick applies to any single time frame. Doesn't matter if you're on the daily, doesn't matter if you're on the 1 hour, as long as you have your engulfing candlestick, the market is destined to go into that favor because the market is showing their hand first. Doesn't matter if you're betting on car races or if you're betting on RC car races. They're at the end of the day, whoever is ahead has the lead. Simply makes more sense to bet on that person versus the person that is not. So now all of these candlesticks together, they create patterns. Obviously you can see the same pattern heading to the upside. You can see the same patterns heading to the downside. And that takes me to my next point, which is going to be candlestick patterns that the market shows you. And now these patterns are almost like, where's Waldo? As soon as you find Waldo in the map of where he would be, you almost can't unsee it. Like, it's actually impossible. Once you spotted him, and that's it. There's no going back. You know where he is at. Same thing happens here. Once you spot these patterns of the market, you can't unsee it. Like, it's literally right in front of your face, and it's going to be there permanently now every single time. And I'm literally about to crack something for you guys that you probably did not know that you had, and that you were missing out by not properly identifying the markets the way you should. Now, this market that you see right in front of you here, not only are we on the line chart, just to make this very simple for introduction, but there is two different types of candlestick patterns in this section right here. You have a head and shoulders pattern and a inverted head and shoulders pattern. And it might not be so obvious right now, but as soon as I spot it out, you're going to have an aha moment, and it's going to be like, where's Waldo? It's gonna be impossible to unsee what you're about to see. So this market right here, actively right now, the first thing that you have to do always is focus on the first things first, which is, where is the market right now? Where is price? And price is at that very point right there. So then this is where you would start working your way down. You would start working from this point to this point to this point, to etc. So you would identify that this market is obviously bullish. It's creating higher highs and it's creating higher lows. So this market is a bullish market. Now, this bullish market was created because of a pattern. Now, what pattern, you may be asking? Well, just to make it very simple and straight to the point, it is going to be a inverted head and shoulders pattern, which is going to be this pattern down at this point right here. So it's an inverted head and shoulders pattern, which is an opposite of a head and shoulders pattern. Inverted head and shoulders patterns usually happen at the bottom of a trend as a reversal, and then head and shoulders happen at the top of a trend as a reversal from the point there. So these patterns are used as reversal patterns. So this is an inverted head and shoulders pattern, which happened at the bottom of the trend to then shift this market to the upside. And then if you notice, this at a little bit more to the left would be a full-blown head and shoulders pattern to then create a reversal for then the market to the downside. So you can see how this head and shoulders pattern then created a bearish market, and then you can see how this head and shoulders then created a bullish market. This is because these reversal patterns are happening at the highs and at the lows of the market as reversal patterns. It is the stronger pattern that you can possibly see in the market. And it is almost so obvious that once you see it, you can't unsee it. It is very obvious that this is a left shoulder, that this is a head, and that then this point right here is another right shoulder. Now, it is impossible to have a head and shoulders pattern without a left shoulder, a head, and a right shoulder, confirming that it's broken through the neckline. Now, a lot of people might believe that this right here could potentially be or is a head and shoulders pattern. This right here is not a head and shoulders pattern, because this can literally just do this. And then what? Where did your head and shoulders pattern go? Well, nowhere. Clearly, it never existed. A head and shoulders pattern only exists once it has broken and confirmed the neckline of the head and shoulders. So this is going to be the neckline at this point right here, which is what's held up by a level of support. So the support is the neckline of the head and shoulders that is created of what? These elbow points, which is going to be these market structure points right here, which are going to be held up by this support. So the only way you have a confirmation of a head and shoulders is once we break through that neckline of the head and shoulders. And obviously the same exact thing applies when you have a inverted head and shoulders. The only thing that changes is that it's simply the other way. This right here, is it a head and shoulders? I'm gonna let you think for a second. Go ahead, I'm gonna drink water. Go, think. No, this is not a head and shoulders pattern. Why? Because this can literally just do this right here. And then where did your head and shoulders patterns go? Nowhere. It never existed. Why? Because it never broke through this neckline right here. If it looks a little bit confusing, all you have to do is flip this chart to the other side, and then you can clearly see that it never broke through the neckline never making it a valid head and shoulders pattern. So you notice it's the exact same thing, just flipping it to the downside, because this is an inverted head and shoulders, which happens at the bottom of a trend. So this right here is not a head and shoulders pattern. If this would have done this, then we have a confirmed inverted head and shoulders pattern that now we can be interested in taking this to the upside, because now the market has then shifted. So this literally happens time and time again to the markets every single day, like to the point where right now, as I'm skimming through this market, I'm seeing tens of different head and shoulders patterns. Now again, keep in mind, these head and shoulders patterns are not always going to be very pretty. They're not always going to look like something like this. You know, it could happen, but the possibility of that is not very high. You're gonna sometimes have a little ugly head and shoulders. There's nothing wrong with a little ugly head and shoulders. Like, you know, we've all been with an ugly person. It's not a big deal. Do it for the game. It's part of what it is. Sometimes you would have something that looks like this, but it's a valid head and shoulders pattern. You would have something like this, and then it would look like this. It's ugly, but it is what it is. It's a head and shoulders pattern. You just want to make sure that you can identify that it is a left, a head, and then a right shoulder to confirm that it is a head and shoulders pattern. This right here is a perfect example of an ugly head and shoulders pattern. This is a left head and then a ugly right shoulder, which then creates the head and shoulders pattern. Clearly happened at the top of the market, which then created the move to the downside. And these obviously also happened in any single time frame of the markets. And it's going to happen every single day that the market has different opportunities for you to trade on any single time frame. Now, there's obviously many different types of patterns, and I have a whole entire video right here that explains to you the patterns that I use in my strategy every single day that give me the best edge over the market. Because just like the head and shoulders pattern, and they happen every single day in the market, there's two different other patterns that I personally use, but I explain into more detail in this video right here, so make sure you go check it out. And this is all just a very simple way of how to read technical analysis and different types of patterns that you can identify when reading the market. And this is all very surface level ways on how to actually see different technical ways on how to read it, because technical analysis trading is simply the most successful route that retail traders have taken over the last decades in order to succeed. And it's what I've been using for the last 6 to 7 years, along with all of my students, that lets them make anywhere from $1,000 to $1,500 a week as a beginner set and forget trader. Now, if you don't know what set and forget is, or it's your first time hearing it, make sure you click the link in the description below, because I have a video there for you that explains to you exactly what it is. And I show you how to identify these patterns and create an edge over the market that's going to make you anywhere from $1,000 to $1,500 a week as a beginner set and forget trader. So if you want to know what set and forget is and what it's all about and how it lets students have results like these or even these, click the link in the description below for you, and you're gonna be able to see what it's all about. And you're gonna get on a call with me every single week, identifying these markets every single week, seeing what makes the most sense. Does it make more sense to buy, or does it make more sense to sell? Because I share my personal trades with my students every single Sunday on a call that we get on before the market starts, so we can actually see what markets are having the best patterns and the best technical analysis. So if you want to make anywhere from $1,000 to $1,500 a week and be part of my set and forget community, make sure you hit the link in the description below, and I'll see you inside. Appreciate you guys watching this video all the way to the end. Hit that like and subscribe button, and I'll see you guys in the next video.